Now, elsewhere, evidence has emerged that UK and US regulators were informed of an international state-led drive to manipulate interest rates during the 2008 financial crisis, but covered it up. This morning, the Times newspaper and the BBC is publishing quotes from a previously secret interview with a Barclays cash trader who gave evidence of moves by central banks and the UK government to artificially push down the benchmark interest rates LIBOR and Euribor. Well, that evidence was withheld from Parliament and from jurors in criminal trials of traders for manipulating interest rates. Well, regulators say that they have met their disclosure obligations. Well, our economics correspondent Andy Verity has led that investigation. And Andy, first of all, just remind us about the significance of LIBOR and Euribor.
Well, you know, when you hear about interest rates, whether it's on your mortgage or your personal loan, actually they're not based on those central bank interest rates that us business hacks obsess about. They're actually based on how much it costs banks to borrow cash on international money markets. And LIBOR and Euribor keep track of those. The way they do that, every morning banks are asked a question. At what interest rate could you borrow cash? They give their answers. HSBC may say 3.53, RBS might say 3.56, Citigroup 3.54. They take an average of all those and you get an average interest rate, which is LIBOR for sterling or dollars and Euribor for euros. Now, banks have been fined $9 billion since 2012 for manipulating LIBOR and Euribor. But we're used to thinking of this as to do with traders making requests for LIBOR or Euribor to go up or down when their banks make their estimates. What we're less used to hearing about is a whole other story that years of investigation have uncovered. Audio recordings and various other material reveals that central banks and governments were involved in trying to push LIBOR and Euribor down during the 2008 financial crisis. You might say, well, that's history, but it has a contemporary significance because between 2015 and 2019, 37 traders were prosecuted for rigging LIBOR and Euribor. But the juries in their trials never got to hear evidence like this audio, this phone call between Barclays executive Mark Dearlove instructing Peter Johnson, a cash trader at Barclays, to lower his LIBORs on instructions from above. Have a listen.
The bottom line is you're going to absolutely hate this, and I've spoken to Spence about it as well, but we've had some very serious pressure from the UK government and the Bank of England about pushing our LIBORs lower.
Can I have that from them?
BJ, I'm on your side 100%. These guys don't see it. They're bent out of shape. They're calling everybody from Diamond to Varley to
Well, Collins just told us he's going to be getting a call from the ECB telling him to put his LIBORs lower as well.
It really is astonishing, Andy, to hear that call, isn't it? And it tells you how much was perhaps going on at the time. And give us a sense of what this new evidence tells us about the high-level interest rate. We heard it in that clip, the high-level interest in those traders rigging interest rates.
Well, I mean, that's just one piece of evidence which we uncovered 5 years ago. But what I found out more recently is this interview that was given in November 2010 by the trader who was receiving those instructions, Peter Johnson, who later went to jail for interest rate manipulation. His instructions given by Mark Dearlove, who was later promoted to be a senior executive in Barclays, and of course mentioning pressure from the UK government and the Bank of England. Now, when Parliament inquired into that in 2012, they weren't told anything about that tape or anything about other audio and documentary evidence which shows not just the Bank of England or the UK government being involved, but Peter Johnson told them about the involvement of the Federal Reserve Bank of New York, reports that they'd been pushing it down, and also data which you can check out from the time, which shows the French banks all dropping as one their Euribor rates by more than they had since ever Euribor began, the record drops in rates along national lines. Now, you report the markets, Ben. When you have a whole market thing, it doesn't happen along national lines when the euro market is international. So that's indication of coordinated national bank pressure to lower interest rates.
And the obvious question then, Andy, what have the regulators and the central banks said about all of this?
Well, no national central bank wanted to comment, Ben, but the European Central Bank told us they strongly rebutted the claims in the report, which they say misrepresent the role of central banks. The UK Treasury said they didn't seek to influence individual banks' LIBOR submissions, and the UK regulator, the FCA, said it had met its disclosure obligations. The FBI and the US Department of Justice, who were told all this and didn't disclose it to the public, declined to comment.
Andy, it is fascinating. Thank you for the details on that investigation led there by our economics correspondent, Andy Verity.